Welcome to our episode of our podcast, Don't Chew With Your Mouth Open, where we'll discuss business, economics, finance, investments, and wealth creation for the global south. Welcome back to Don't Chew With Your Mouth Open. After we've gone through a couple of episodes, we received a bunch of comments and questions. So in this episode, we'll be looking to address those questions and comments. Hopefully, I can answer them meaningfully. I haven't seen these comments yet or questions, but we're willing to give it a bash. So here we go. First question. You often talk about private equity structures. Can you break down how a fund actually makes money? Management fees and carry are still a bit confusing. Wow. This question needs a whole episode, but simply put, a fund is a basket where people who have lots of money or savings put that money into that basket, and the fund manager is responsible for making sure that basket of money is deployed in the right investments. And when those investments yield fruit, the fund manager gets rewarded, one, by a fee for managing that basket, and two, as a percentage of the upside. So after he's returned all the money in the basket, any extra money on top of that, they share that money 80-20 with the investors. That 20% is called a carry. So a carry is an incentive for the fund manager to perform above what they say they are able to perform. And when they do that, they share that 80-20 or depending on the agreement. So the fund manager is the expert. They will look after the basket. The basket is the fund where all the investors put their money into, and that basket is distributed into assets and invested into assets. When those assets are sold, the money comes back into the basket. And when the initial investment plus the return is given back to the investors, anything above that is shared between the fund manager, the person responsible for the basket, and the investors. That's an incentive. The fee, management fees, to pay the fund manager to go about administrating that basket profitably. That was a tough first question. Second question, how do you find deals? Do deals come to you or are you constantly hunting? Well, both. We constantly hunting and deals do come to you. Over time, when you start having some form of reputation, people start talking to you. We are an emerging fund manager, so we're still building out our case and showing how we can do the job. But we typically find deals through our networks, through other advisors, through accountants and lawyers who work in the similar spaces we do. Every company needs an auditor or an accountant. Every company needs tax. So if you have a relationship with tax consultants, with accountants, they can link you up with sellers or motivated sellers for businesses. And that's how we go about doing it. Hope that makes sense. Question 3. Can someone from a non-finance background break into private equity or deal advisory? If so, how? So yes, unlike harder science subjects, finance can be learned at a later stage in your life. There's lots of courses for finance for non-financial managers, MBAs, CFA. There's lots of pathways to get there, but one can learn finance pretty in a pretty short space of time. And after you've learned it, you then can break into the field. Typically, there's a preference of people who don't think like most of us in finance. That provides insight, provides a different point of view and a different research ability. So I would say find a course that teaches you finance and private equity. There are plenty across the board. Do that course and post that. Start applying and knocking on doors in private equity, and I think you'll have a shot. Okay, question number 4. You speak a lot about wealth creation. What is the one mindset shift that helped you most as a black entrepreneur in private equity? Wow. Yes, I do speak a lot about wealth creation. I think it's an important aspect on our side of the world. There's not a lot of capital formation. There's not a lot of people who can gather money. So the more of us who do that, the better and easier it will be. Secondly, the mindset, I think, was a concern about where we stood as a people group. I think the inability to put together the right capital to go after the things we want, to build businesses we want, to engage the market meaningfully, I think has driven me a lot to be quite focused on wealth creation and social mobility. I think the more of us who live a better life, the better we will all be, and we will be able to do more work, support more people, and develop our economies. So yeah, I think the mindset shift was production. How do we become better? I think being a black entrepreneur in private equity is, I think, on our side of the world is normal. It's normal for black people to be in the business. I think what the challenge will be is how we become global, how we become the people who can compete with the best of the best at finding good companies and making them great. Next question. I'm running a growing business and I've been approached by an investor. How do I know if it's a good deal or if I'm being taken for a ride? Well, the first point is to say this is where you need an advisor. You need someone who's registered with the FSCA, who can help you understand the requirements of the person who's approached you. Most of the time, good deals fall over around advice and compliance. So, is your company ready to receive an investor? How are your finances standing? How is your tax doing? How are you looking in terms of your market? Do you understand? Can you explain your unit cost? And if that's the case and it's going well, then you can say the next bit. The next bit being, who are they? What is their track record? Ask for references. But my best advice to you would be bring in an advisor. Call Shiloh Capital and we'll help you. But bring in an advisor you trust who can assist, who can give you insight into what the other party is looking for. And yes, it will cost you money, but you'd rather pay the advisor to help you than get into a bad deal. Transactions are not easy to unwind. It's not a stock market where you can sell today and have your money in 3, 4, 5 days. Private companies are difficult to unwind. It takes a significant amount of time. So I would advise you to say get a good corporate advisor who can look at the offer, look at what they're proposing, and explain it to you and give you comfort about whether this is what you want to do going forward. What is your take on sweat equity, especially in early stage partnerships? Okay, this one is a bit tricky because it comes down to value. What do you think is valuable? Sweat equity often, in my experience, is used for someone to get into a business without having to pay for it. So the value alignment is important. What are you bringing that is not capital? And how do we value that in our cap table? So how, if you say I'm bringing in a network, what does that network mean? What do those contracts mean? When will they get here? How will we work through that? So the sweat equity must come with value. If it's not valuable, then it's really not sweat, because sweat implies you've worked and you've brought in value. So my view is it must be treated carefully, and it must be valued appropriately, and again, bring in an advisor. Is it better to invest in public markets or private equity if you have access? Which builds real wealth faster? So I don't think there's a better. I think there is a preference, and the preference is risk. So what's your risk preference? What public markets provide is liquidity. So you can get in and out of a transaction relatively quickly. But what they don't provide is control. So you hand over your capital and you make peace with the fact that the management of that business will go about running the business in a way that's profitable and growing and will give you returns. And you analyze that performance and the macroeconomic environment and make a decision. Now, private equity is more microeconomics. You have influence over the board, you have influence over the management, you see them every day, you may even go to where they are. You have influence over how it's spent, the strategy of the business. So it's more operational. It requires more of you than just to allocate capital. So it comes down to your preference. So if you are an investor who's quite happy to simply be a capital allocator, who puts money into something and watches other people work and sweat that, then private markets may not be for you. But if you're an operator and know how to drive value with management, with operations, with help, then private equity may be for you. The speed now comes down to the opportunities and the strategy you execute going forward. Generally, wealth is built little by little, not at a rapid pace. So the faster question is a bit of a concern. You need to sort of figure out what it will look like over a 5-10 year period than rather a 2-3 year period. Yeah, that was a good question. What is your strategy in this economic climate? Are you sitting on cash, deploying, or restructuring? Well, you've only given me 3 options, but we are aggressive when everyone else is scared. We think there's a lot of opportunity. So to walk you through sort of Shiloh Capital's view, and Shiloh Capital Global, as in us and our partners which we work with, in America, 10,000 baby boomers will be retiring every year. These people own businesses and are going to look to sell those businesses because, excuse me, their family members are not really keen on running the business. This phenomenon exists on our side of the world as well in South Africa, where you get great entrepreneurs who are aging out and their kids are in the UK or Australia or Canada or anywhere else in the world and really don't care much for the business. So it's a great business and the operator, the owner, the entrepreneur is looking to exit. So our thesis is we're going to be looking for great businesses owned by retiring entrepreneurs. Now, that market climate doesn't necessarily factor a lot into that because a trigger to sell is not necessarily driven by the up or down of the market. The trigger to sell is a lifetime event or a lifestyle event in the current owner, right? So we typically are aggressive on strategy, and then we are very flexible on economic circumstances. So when things change, we really look at how we can acquire quality businesses. So when we look at the economic climate, and yes, the macros matter, but how does the business work? How does it look? Can we make money? Can we drive strategy? Can we introduce it to new growth markets? So there's a part of it, yes, we're sitting on cash, but we are more deploying and restructuring than cash. We think the opportunity is ripe, and we think a lot of people don't want to participate in family-owned businesses because they are hard to buy. And if there are few people who are doing what you're doing, I think it makes it simpler to do it. So that's our view. Okay. You keep it real about social mobility. What's the hardest part about trying to break generational cycles of poverty through entrepreneurship? The hardest part. I think the hardest part is accepting your present condition. I think we often, and I've said this to a few friends of mine before, when you read the story of David and Goliath, a lot of the time we see ourselves as David. Right? We see ourselves as the hero who kills the giant. But in reality, that story is a lot about Jesus being the one who delivers the people of Israel from this oppressive giant, right? So we, in reality, are the people who are hiding from the giant, not necessarily David. And the point to say is, if you see yourself as David, where in reality you are part of the children of Israel hiding with Saul, it becomes difficult for you to actually realize what you need to do to get out of poverty, and what types of entrepreneurship are open to you, what types of funding are open to you, what businesses can work for you. So I think the hardest part is accepting your condition, accepting where you are in the social structures, and that social structure then will give you insight on what you should, can, and must do to excel. So I think that's the hardest bit, because we're all aspirational. We all want to be more than we are today. But yeah, one thing is tough, but geez, these are hard questions. You talk a lot about the global south and southern Africa. Is the private equity scene really growing there, or is it hype? I would say we are trying to grow it. We are trying to grow it. We live here. We do the job here. I assume this question is from someone outside of the world. We live here. We grow here. We understand it. We understand how to buy great businesses, hold them, and exit them at good prices. So I would say it's growing, but growth is different. One animal will have 3-4 months of pregnancy and the baby rolls out. Another animal will have 18 months and the baby rolls out. So either way, both are growing. So I think we are growing, but not necessarily with lights flashing for everyone to see. I think we're doing it inch by inch, line by line. How do we make finance and investing more accessible to young people in township or rural areas? I think cell phones. I think access to information via cell phones. I think mobile technology enables people to access information easier. I've got a friend of mine who runs a MNVO. He provides a platform for free data access, especially to people in underserved areas. And that then allows people to research and be able to read and understand what it takes. So I think cell phones are the best path. Mobile technology that gives people information and knowledge they can read and engage in terms meaningful to them. I've got another friend who's developing apps that a person can communicate through WhatsApp in their language and buy electricity and water and engage the internet using their home or domestic language. And that's a mobile tool. So you can be sitting in rural Limpopo and be able to communicate in Venda online or with your phone through voice and text and learn about investing. So I think mobile technology will be the way to really make it accessible. Okay, love the show title, but why don't chew with your mouth open? What is the story behind it? Watch episode 1. That's what I'll say. But the summary of it is to say, so me and a group of friends were sitting down one day with an uncle of mine, and we were lamenting how there's a lot of black entrepreneurs who, when they make it, they buy 50 Maseratis and 20 Range Rovers, and over time that comes back to haunt them. And it's a desire to enjoy your wealth and show it, and that's what people pay attention to. And another colleague of mine who owns a restaurant, he was saying SARS now sends people to look at the kind of cars that are parked outside his restaurant, so they can follow those people and see how they spend money. And so, having gone through that and having this conversation with an uncle of mine, he's now in Kenya. He's moved to Kenya. He said the problem with our age group is we chew with our mouth open. We want people to see the food we have, but in reality, you should actually not chew with your mouth open. People shouldn't see what's inside your mouth. And the goal of that was to build wealth without it being ostentatious, without it being something that draws eyes to what you're trying to do. So that's why the name of the podcast. But yes, watch episode 1. I noticed you're not afraid to challenge conventional wisdom. Do you ever get pushback from being too direct? Yes, a simple answer. I think I'm less direct now than I used to be, but yes, lots of pushback. I think having a strong view will often be challenged, and one must live with that. And look, I'm not afraid to change my mind if I encounter new information. Can you share some more personal stories, like worst deal or biggest lesson from a failed investment? Biggest lesson: don't fall in love with the transaction. Go after it. If it works, great. If it doesn't, because once you fall in love, you'll compromise investment and deal principles to make the deal work, and then you do a bad deal. Worst deal? I guess all the good deals I never closed. I thought would be my worst deals. I think the second bit is also don't make any assumptions that you are the only person who wants to buy this business. There's 3 businesses we've tried to buy. One was listed, one was an auction, and one was a private seller. And we realized all 3 times that the sell-side advisors were using our offers to up the offer with whoever they actually wanted to buy the business. So if you fall in love with the deal and you assume you're the only one who sees the value, it's going to hurt you and you're going to make bad decisions. Yeah, I think we'll leave that there. How do you stay grounded in a world where money and power often blur values? Well, I think it comes down to who are your close friends and relatives, who has the input into your life, who gets to speak to you, especially as a man and male friends. You as a man, you need good male friends who are going to tell you things, regardless of how uncomfortable they may be, that are sound for you. That you know that these people care about you, they love you, they're concerned about you, but they're going to tell you the truth, regardless of how uncomfortable that is, especially around your values. And your values always get challenged when you make money, in one way or another. People have strong values until they've accumulated some or encountered the opportunity to make money, and then the reality of who you are. The relative of mine who used to say your character is like toothpaste. We don't know who you really are unless you're squeezed. So when we squeeze you, what comes out? And that's the reality of it. Personal questions. What would you do differently if you were starting out again, knowing what you know now? Two things. The first one is I would build outside in instead of inside out. So I would spend time educating global capital about the opportunity set on our side of the world. So getting global capital in, then trying to procure capital inside South Africa to try and go out and buy assets and build out. It's harder to make a deal when you are in your home. profit in his own home than when you're coming in from overseas and say we are representing XYZ fund from Abu Dhabi, from London, from New York, wherever it is. You get to meet the founders quicker. People treat you differently. So the first thing is outside in. Second thing is I would have focused a lot on governance and compliance. Trying to fix things post is harder than doing it right from the first time. Fund management is a highly regulated industry, so there's a lot you must do around compliance, around the exams, around submitting to the regulator, around the Reserve Bank and foreign currency moving in and out. So that detail, educating myself and focusing on that detail. I think those would have been the two things I would have done differently. Three more questions. Okay. What's more important, access to capital or access to networks? Jeez. I think both. But we live in a part of the world where capital access is hard. It's very, very hard. So if you're going to build relationships that help you build capital, I think you are then able to build relationships that help you build your network. Because your network must help you eventually build whatever you're wanting to build. So it's very hard. I think we emphasize networking more than we should. Because networking is not exchanging business cards and shaking hands. It's when the trust has been built to be able to transact. And that's hard. It's a hard thing because capital generally moves at the speed of trust. So it's a complex thing, but I would say access to capital, if you're going to choose between the two and you are wanting to invest and build, I think look at who can fund what you're trying to do and go to them. Do you think the PE model can ever be truly inclusive, or is it inherently elitist? Wow. Well, I think by design it is elitist because very few people can get in on the investor side. That's a very difficult thing. I think that's going to be challenged by digitization and tokenization of funds. I think private equity funds are going to face that going forward, where anybody and everybody can buy into a fund. But the fund management side is also quite a difficult hurdle to jump and get to. To raise the capital is also quite a... So I think by design it's inherently elitist, but by impact it can be inclusive. So how you go about investing can be inclusive. But I think there's going to be some changes, especially around the digitization and tokenization. But yeah, it's a very small club, and not a lot of people can get in, and those who do, not a lot of them succeed. So it is a difficult place to be. If you had to teach my 17-year-old son about money in 10 minutes, what would you say? Don't chew with your mouth open. So there's a statement my dad used to say to me when I was much younger. It's in Zulu. And it'd say, "Imali ngadliwa ingati yabola." Like, don't eat money like it rots. So when you earn money or you're given money, it's an advantage to you. It's a plus to you. When you spend money, it's a minus to you. So you want to have more pluses than minuses across your life. There'll be times you'll have to risk some of that money to increase your pluses, and those will be minuses. But generally speaking, you want to accumulate more pluses than minuses. And I hope that makes sense. I don't have 10 minutes, but money should be treated with respect, and add the pluses. Add the pluses, reduce the minuses for as long as you can live your life. Okay, that's a wrap. Geez, that was a lot. Uh, I'm glad I didn't read these before, or wasn't allowed to read them before. But thanks for tuning in to DCWYMO. And please continue to comment and share. And hopefully, we'll have another session like this where I respond to your comments and likes. And thank you for listening, and see you in the next episode. Cheers.